Hi, my name's George Vessey, based in the UK, and I'm the lead FX and macro strategist here at Convera. And today I'll be walking you through our latest global FX outlook, which can be found on our blog page. In this monthly report, we feature the key themes and events which are shaping trends across global financial markets, and we provide some extended research on FX volatility analysis and FX forecasts. And we take a scenario-based approach here as usual, so we believe it's a more responsible way to safely navigate what is a very unpredictable market at the moment. Indeed, volatility has picked up from the troughs of last year as a result of the uncertainty around numerous things, monetary policy, that is when and by how much central banks will cut interest rates across different regions, and that's based on the incoming economic data that we have to assess. But it's also due to elevated geopolitical and trade uncertainty. And given these multiple big themes that are playing out at the same time, FX markets appear slightly directionless at this stage. But before we jump into the thick of it, it's good to set the scene with some simple currency insight to begin with. So wrapping up the month of February first. So February, it was a month of two halves, really. Financial markets mostly positive in the first half of the month. FX markets shaking off some of the concern around tariffs. The US dollar weakened, global equities rose. The US dollar, for example, fell to 2-month lows in the earlier on in the month. However, that weakness didn't really last as we saw volatility climb across different asset classes with the twists and turns of the tariff narrative and the stalling of the peace deal hopes in Ukraine. Were it not for this geopolitical uncertainty that re-emerged towards the end of the month, we think the dollar would have extended its decline across the board, given that US data has been disappointing recently, causing Fed rate cutting bets to increase and weighing heavily on US yields. But of course, the dollar's safe haven status has supported demand for it in times of the heightened ambiguity and risk aversion that we've seen recently. As for the euro, it actually climbed around 4% from its lows of this year against the US dollar, and that was as a result of Eurozone economic data coming in slightly better than expected. Some hawkish comments from the European Central Bank that we've seen. Plus, there was this notion of tariff fatigue setting in, particularly at the start of the month. There's just been so much noise on the tariff front with actually very little action in comparison. So traders we're sort of betting on Trump using it as a negotiation tool rather than actually following through to some extent. But obviously that didn't really last. Trade exposed currencies still remain vulnerable, and like the euro, failed to build on gains, and euro dollar in this case pulled back from the 105 resistance level. The pound is an interesting one. It's sort of in an identity crisis, if you like, at the moment. If we think in January, it was classed as more of trading like an emerging market currency with UK yields rising, but the pound falling. And now it's sort of deemed potentially a tariff safe haven currency due to the UK being less exposed to Trump's tariff threats. So the pound has held up pretty well against most major peers as a result. And like the euro, the pound rose around 4% against the US dollar before losing steam at the 2-month high of around 127. But against the euro, the pound remains close to that 9-year high, around a 122 mark. It's still above 121. It closed February out above that level, which is the highest monthly close since 2016. So good news for sterling traders there buying foreign currency. Finally, the Australian dollar. This is one of the more trade-sensitive currencies caught between the US and China as major trading partners. It's also been responsive to commodity price trends. They've been turning lower of late, hence the Aussie dollar remains near 5-year lows against the US dollar. And it didn't help too that the Reserve Bank of Australia delivered its first rate cut since 2020, weakening the Aussie dollar's yield appeal. So let's move on to the key themes that we're keeping an eye on and what's driving this volatility and these trends in FX. Well, again, to reiterate, policy uncertainty is what it's all about. It's sky high at the moment. Since President Trump's election win back in November, global policy uncertainty has surged across the board. And this is partly due to his unpredictable leadership style and shifting political positions and priorities. His administration has shaken up trade agreements, changed alliances, and has often taken an aggressive stance in economic negotiations, which has kept markets on edge. And as a result, investors now face a backdrop where sudden policy changes and increased volatility have become the new normal. And also the clash between Trump and Zelensky in the Oval Office last week, that not only decreased the probability of an immediate peace deal being signed, but it could be seen as an eye-opener for European leaders as well, meaning that they need to step up not only defense spending, but also be more proactive when it comes to the war and settling it as soon as possible. So this geopolitical theme, of course, has repercussions on trade, supply chains, commodity prices, diplomacy, and that can have far-reaching implications for the rest of the world. The second theme is related to tariffs, whether or not they're inflationary or stagflationary. The risk is that they are inflationary. We have already seen that US inflation has significantly dampened expectations for Federal Reserve rate cuts in the first half of this year. The latest inflation data coming in stronger than expected, with last Friday's US PCE inflation print, which is the Fed's preferred measure of inflation, confirming that the 3 and 6 month trends are accelerating again. And so this is reinforcing concerns that price pressures remain persistent and is forcing the markets to reassess the timing of monetary policy easing by the Fed. However, on the flip side of all this, the US economy is actually slowing down at the same time. The US Economic Surprise Index has fallen to a 2-month low. Data on housing, the consumer services data, it's all been surprising to the downside. And that's caused a sharp downward revision of growth expectations in the US and has led markets to price in more rate cuts recently, despite these inflationary concerns at the same time. So as per the final theme on how the FX market is reacting to all this, particularly the US dollar, on the whole, this Fed pause narrative is being driven by these rising inflation expectations rather than stronger macro data. And therefore, the US dollar has really been struggling to benefit from the Fed holding rates steady because this whole US exceptionalism narrative is being questioned, which is why all G10 currencies are now in positive territory against the dollar year to date. So delving into one of these key themes a bit more, of course, it's going to be the policy uncertainty one, specifically trade policy uncertainty, because that's incredibly high. It seems that Trump is contradicting reports from his cabinet officials regularly when it comes to the tariff rollout, recently saying that levies will come into effect this week on Mexico and Canada. Furthermore, Europe could be hit as well with a specific 25% tariff, but there's really a lack of concrete guidance, and that's fueled market anxiety with businesses and policymakers scrambling to assess the potential economic fallout of all this. So all of this conflicting information, the delays that we've had to the tariff rollouts already this year, do have people questioning whether it's really just a negotiation tactic from Trump. And while volatility rates across asset classes are mostly higher than or they were on average last year, they are not even nearly discounted the impact of a real tariff rollout that could have on markets. And that's why this is a theme in focus, because it has the potential to really rattle markets even more than it has done already. So what are the currency implications that we've seen year to date and in February? Well, as I mentioned at the start, most G10 currencies are actually up against the US dollar year to date, but it was the pound, the euro, the Japanese yen, they were the biggest winners in February. The dollar yen exchange rate, that's experienced the widest trading range year to date of almost 7%, retreating from the yearly highs around 158 in January to 5-month lows of 148 last month. And this was due to safe haven demand for the Japanese yen, but it also reflects a view that the Bank of Japan is expected to raise interest rates twice this year versus other major central banks cutting, which is narrowing rate differentials in the yen's favour. It was a slightly less volatile month for the pound and the euro, both swinging less than 4% in February against the US dollar, but both trading in the top 10% of their February and year-to-date ranges, partly thanks to the growing optimism that we saw for a while surrounding a peace deal between Russia and Ukraine. The German elections went through without much turbulence, and the softer dollar narrative owing to the weak US data that we mentioned at the start also allowed those currencies to stay in the top end of those recent trading ranges. Specifically for the pound, though, this was boosted as well by stronger private pay growth in the UK and sticky inflation prints as well, which led to a scaling back of Bank of England rate cutting bets. So that helped the pound's yield advantage. Plus, as I mentioned, the UK's risk of tariffs from the US is minimal compared to other countries because the UK's got a goods trade surplus with the US, which is quite unique. So it keeps it out of the firing line of Trump's tariff threats. and that's aiding the pound in this tariff-driven environment that we're in. Thus, after appreciating against just 6% of its global peers in January, the pound actually appreciated against 73% of its global peers in February. In terms of the positioning relative to historical average rates, we like to highlight where opportunities might lie, whether exchange rates appear over or undervalued. So this slide here is our value indicator slide. It shows where currencies are in relation to different average rates over different time periods. And it shows here that the pound is almost 2% higher than its year-to-date average against the US dollar, but is over 1% below its 5-year average rate of 128. For the euro dollar is even more undervalued relative to that 5-year average, 5% below that. The Aussie and the Kiwi dollars are a significant note in this respect. They're 8% and 10% lower than their 5-year averages, respectively. This is due to the weak Chinese economic outlook and tumbling commodity prices, denting economic growth prospects, but also the tariff fears due to these countries being greatly exposed to global trade. And then finally, the Canadian dollar, despite being in a kind of steady-ish trend in February, quite range-bound really, valuations remain moderately stretched versus shorter-term averages, although it's 8% below its 5-year average versus the US dollar. So no surprise there really, given the tariff risk premia rising and jolting implied volatility expectations in the CAD over the course of the next month or so. So where does this all leave us in terms of FX and the outlook for different currencies? What we are expecting to unfold over the next month and the remainder of this year is highly unpredictable, to be honest. It's highly uncertain what could happen, what Trump could say, and the direction which he takes with tariffs. So it's really hard to formulate or to calculate exactly where exchange rates will end up, but it's inherently inaccurate. It's inherently inaccurate at the best of times as well, trying to predict exactly where exchange rates are going to go. So we do lean on a certain direction, towards a certain direction, of course, but we do also advocate instead to be well informed about different scenarios and why they might unfold and how high or how low exchange rates might go based on certain assumptions coming to fruition. So let's take a look at some of these forecasts then. Euro dollar first. As you can see, our baseline forecast has been revised sharply lower than where it was a month ago. So expectations of a sort of 102 to maybe 101 trading over the next quarter or so. This is because of the renewed threat of the US imposing tariffs on European imports. The tariff threat continues to cast this long shadow over FX markets, but the timing of that impact remains a tough one to call. Tariffs on the EU as a whole or on specific sectors could push euro dollar closer to parity in the second quarter. This is also when the ECB is likely to cutting interest rates to below 2%. So rate differentials don't favour the euro here either. However, there is a possibility that Trump's tariffs are not as aggressive as we fear, and coupled with softer US data, namely labour market data, that leads to the Federal Reserve cutting interest rates more and allowing euro dollar to recover back to above 105 onto 106, with the outside risk of a strong rebound in global risk appetite in the wake of a peace deal in Ukraine and improving global growth prospects, helping the pro-cyclical euro recover potentially up to the 108 as the upside scenario. Versus the US dollar, sterling has been revised lower as well, our central scenario there, which includes one standard deviation above and below the baseline forecast. That's dependent on growth and rate differentials, really. We think the 127, potentially 128 could be the top end of the range if the UK shifts to a tighter fiscal, looser monetary policy setting. We could see the pair in this case trading in the lower realms of the 120s over the next quarter or so. The weaker UK growth outlook, the higher debt servicing costs mean that the UK government's probably going to have to announce real-term spending cuts this month. However, as previously mentioned, we have to remember that the UK is not on the front line of the tariff wars either. So we think the downside scenario of sub 120 is unlikely to play out, whereas like the euro, a sharp rebound in risk appetite, if tariff fears ease and geopolitical tensions abate, could allow the pair to climb higher. into the higher 120s, potentially the 130 mark in the second half of this year. But this is also assuming that the US economic data continues to disappoint, therefore leading to narrowing growth differentials and potentially rate differentials favouring the pound if the Bank of England cuts interest rates less than the Fed as well. Remember, these are scenarios, so that would be the upside scenario where tariff risks was recede completely, global trade and growth outlooks improve, and also the Bank of England cuts rates less than the Fed. All of this combined could be enough to push the cable rate up towards 130 again. But all of these things have to align, in our opinion. For the pound versus the euro, looks likely to get caught between some two main key themes over the coming months. Internationally, it's all about trade and the EU, which is seen as far more exposed than the UK when it comes to Trump's trade war. Again, to reiterate, the UK's goods exports are reasonably small to the US, and it's helpful that the UK actually runs a goods trade deficit with the US compared to the EU, which runs a huge trade surplus, which is why they're in the EU is in Trump's firing line, and the euro is more exposed to this. However, as I mentioned on the previous slide, the domestic story for the UK looks sterling negative. The Chancellor, therefore, is threatened with breaching the government's fiscal rule if growth forecasts are cut, and therefore tighter fiscal policy, which we might see this month, could be a catalyst for more Bank of England easing to be priced in, and that keeps the sterling euro exchange rate confined potentially to its post-Brexit trading range, with 121 to 122 seen as the upper limit there. Heading over to the APAC region next, the Australian dollar, that's rebounded along with most G10 currencies as the US dollar lost some ground. But the US-China trade war should prevent much more reappreciation, really. The Reserve Bank of Australia, as I mentioned at the start, kickstarted its easing cycle, and there may not be much commitment in terms of future cuts, but US rates are likely to remain higher than Australia, and that limits the Aussie's appreciation or ability to appreciate more. Moreover, if the scenario on US protectionism does materialize, then the RBA will probably have to support the economy more, could cut rates more. Hence, we see the lower level of the central scenario panning out over the next few months with 0.61, a potential downside target. And then finally, the US dollar against the Canadian dollar. Unsurprisingly, again, that baseline forecast has been revised higher in favor of the US dollar, but the pair has recently pulled back off the highs after the US tariff scare. We think it should, however, be supported around that 142 mark as the US has levied steel and aluminium duties, exports worth around 1% of Canadian GDP, whilst also the risk of a new US universal tariffs at a later stage does still remain substantial. On the monetary policy front here, the Bank of Canada's baseline assessment is that US tariffs are going to cause a clearer negative growth impact compared to the inflationary effect in the first year. So that on the margin suggests that additional risk to the downside of the CAD curve, which is now discounting 2 more cuts in 2025. So that all could drag the Canadian dollar lower against the US dollar, i.e. The dollar CAD exchange rate rebounding to the likes of the 145 or 146 by the summer months. So that's it from me. If you want to find out more around these topics and further details on other currencies, forecast scenarios, then you can read our Global FX Outlook report, which is on Convera's blog page, as I mentioned at the start. And on that blog page, you can also access the rest of our macro and market research. And that includes our bi-weekly podcasts, and that helps you keep abreast of the changing trends and dynamics of the market and international payments. So best of luck, and hope to see you next time.